Hello and welcome to the lecture, the first part lecture for Chapter 9. Before I get started on this lecture, I just wanted to take a moment to tell all of you that I miss you and I miss meeting together 3 times a week in our class, and I hope everybody is okay and staying healthy, both physically and mentally, emotionally. And I want to encourage you to give me a call anytime you have questions about our class or about what's going on at school or anything else. I welcome your give me a call. My cell number is 360-556-3621. You can call anytime. I'm available. Leave a message if I don't pick up. I do keep my phone on silent when I'm recording these lectures, so you might miss me in that regard. But please feel free to call or, of course, email. So now on to Chapter 9, current liabilities and payroll. So now we're jumping to the other side of the balance sheet. So we've been talking for several chapters about assets. We started out with cash and then accounts receivable and inventory and long-term assets. Now we're going to talk about current liabilities. In this chapter, next chapter, we'll talk about long-term liabilities. So today I'm going to cover the first 4 learning objectives. We'll talk about notes payable and related interest. We'll talk about how to deal with sales tax, contingent liabilities, and then warranty obligations. And then Monday's lecture, which I'll record over the weekend, we'll talk about payroll and then classified balance sheets. So payroll is an interesting topic because obviously it affects all of us. So some definitions before we jump into kind of the mechanics of liabilities. First of all, a creditor. Another word for that is a lender. That's the entity that's making the loan or extending credit. So a bank, your suppliers, if you're in business, the people that supply to you are creditors because they're granting you credit. Credit card companies are creditors. So the opposite side of that is the debtor. That's the person incurring the debt or the entity incurring the debt, so the borrower. So we've talked about this from the creditor's perspective. Back when we dealt with notes receivable, we were the creditor and we were recording interest revenue. Now we're going to switch over and be the debtor. And it'll be the exact same way. Rather than having a note receivable on our books, we'll have a note payable on our books. Rather than recording interest revenue, we'll be recording interest expense, but there's symmetry to it. So here's a definition that we haven't come across yet that's going to be important, and I'll talk more about it in Monday's lecture, and that's a current liability. So a current liability is any debt that has to be paid within the upcoming 12 months. Not between now and the end of the year, but between now and the upcoming 12 months. So it's a moving window. That's really important for judging a company's ability to pay their debts as they come due. We'll see that when we come to Chapter 14, and I talk about that. It's a really good way to assess, say, for example, you're the creditor, and you want to assess whether somebody can pay you back, which is critical. We would look at their current liabilities. And counter to that, a long-term liability is anything that is paid beyond 1 year. So at a lot of companies, that's a long-term debt. It might be a mortgage on their building, that sort of thing. Accounts payable, those are the informal kind of payables, kind of like accounts receivable are informal. Accounts payable is the counterpart to that. I order some supplies from a company, they ship them to me and send me an invoice. That's an accounts payable. It's kind of an informal arrangement. In contrast to that, note payable, that's where I've signed a document, a promissory note that I owe somebody money and there's interest and maybe collateral associated with it and all of that. So note payable is a counterpart to a note receivable. So looking at some transactions here on our grid, and again, keeping in mind that this is very much should remind you of how we handled note receivable. But now we're on the other side. So we're the company that's borrowing money from big bank for a year at 6%. So the first transaction there, we get $25,000 in cash and we have a $25,000 note payable. We've done that transaction before in the very beginning of class. So the step here is that the red line on our transaction grid on the screen there, it represents the end of the year. So at the end of the year, This is on April 1st, so if my math is right, that's 9 months remaining in the year. So at the end of the year, I want to record that I owe somebody interest. I have interest payable, interest liability, and I should recognize interest expense because I've owed that money for 9 months now. So 25,000 times 0.06 for 6% times 9 over 12 will give me $1,125. So I record that liability. I owe that money. At that point in time, December 31st, the total amount that this company owes is $26,125. They owe the principal and they own, didn't have my phone on silent. They owe the principal and they owe the interest payable. And then I recognize interest expense. So that's what's going on line 2. Then on line 3, when it comes due, I want to recognize the remaining interest. So that's what I do on line 3A there. So now I'm saying 25,000 times 0.06 times January, February, March. 3 divided by 12, I get 375. So I recognize that liability and I recognize expense associated with that. And then I pay the debt. And in this simple example where I pay the full amount of the principal plus all accrued interest at the maturity date when the loan comes due. So I paid the creditor $26,500. That reduces my note payable by $25,000 and reduces my interest payable by $1,500. So both of those end up at 0, meaning I have no debt at that point. I don't owe the principal and I don't owe the interest anymore because I've just paid it. So I'll do a separate short video that goes through exercise 9-1A to work through that. That'll help you with your homework as well. So the next subject is sales taxes. So any of you that have ever bought anything, especially, for example, here in Olympia, where the sales tax is nearly 9%, I think it's 8.8, know that when you buy something for $100, $100 is not what you pay. You pay extra money that goes to the state. So in reality, part of the sales tax goes to the state government, part of it goes to the county government, part of it goes to the city, and sometimes there are subsections within a city's taxing districts that get some additional sales tax. So the sales tax rate for a particular store depends on where the sale is taking place, that particular address. So they would have a rate that might be 8.8 or 8.9 or 8.6 or something like that. That would determine their rate. So they collect that. The business collects that sales tax on behalf of the state from customers. And then monthly or quarterly, they remit that sales tax to the state by filling out a form online. And that tells the state how to disperse that money to the county, the city, and the taxing district. So it's one payment to the state, and then the state disperses that to other government entities. So the business is really kind of a pass-through. They're responsible for collecting it and then passing it on to the state. So in the example that we've shown here, the company makes a $1,000 sale, and in this case, there's an 8% sales tax. So the customer pays $1,080. Now notice on line 1 there under retained earnings, we recognize a $1,000 sale because that's the value of what we sold. That's our revenue. And then I recognize a sales tax payable, money I owe the state government of $80. The next case here, the company X collects $21.60 for providing 2,000 in services, another similar kind of transaction. So in that case, we collect $21.60. 2,000 of that is retained earnings, $160 is sales tax payable. Now at the end of the quarter, we remit the sales tax to the state government. So we send the state government $240, our cash balance goes down, and our sales tax payable goes to 0. There's no expense or revenue associated with paying the sales tax to the state. One thing that's important to know is it's the responsibility of the company to pay the sales tax to the state on their sales, whether or not they have collected that money from customers. It ends up being the company's problem. So it's really important for companies to understand the rules about when they have to collect sales tax and when they don't, so they're not left holding that bag. As an example, if somebody is buying the product for resale, they're a wholesaler, then they don't need to pay sales tax. It's only the final sale to the consumer where sales tax is collected. So in that case, you would need a resale tax certificate from that business to make it okay for you not to charge them sales tax. The next topic I want to cover is contingent liabilities. So those are liabilities that arise from past transactions if certain things in the future occur. A good example of that might be lawsuits. Warranties are a special category that we'll talk about. So if I have multiple people that have sued me, that based on actions I've done in the past, maybe I've given faulty product to customers and people have been injured and a bunch of them have sued me, then I would need to recognize a liability for the fact that I'm going to have to pay out money on some of those lawsuits in all likelihood. Another example would be warranties on cars, and I'll have a couple slides about that specifically. When Hyundai sells a car with a lifetime warranty, they know they're going to have to make some repairs to that car. So they should recognize the expense and the liability in the period in which they sell the car, because it's based on that sale in that period rather than something in the future. So there's two criteria that we have to look at. One is, what is the likelihood of having to pay out money in the future? And the other is, can it be measured or not? So can it be estimated or can it not be estimated? So we need to record it when it is probable. There are three categories of likelihood: probable, reasonably possible, or remote. So in this case, we care about things that are probable, 50% or greater that it's going to happen. In terms of measurement, there are some types of expenses that can be estimated and there's some that cannot be estimated. There's just no basis for making an accurate estimate. So we care about ones that can be estimated. So here's a chart, I think I got this from our textbook, that shows kind of how we handle things like that. So a company, an accountant in the company needs to consider at the end of the year what kind of contingent liabilities might exist, and then they need to go through this process of kind of thinking about each one. So if it is both probable and estimable, I can never remember how to say that word right, estimable, so we can estimate it, then we need to recognize it in the financial statements, meaning recognize an expense, which reduces retained earnings, and recognize a liability and identify it as a contingent liability. If it's reasonably possible, so maybe it'll happen, maybe it won't, and we cannot estimate it, then we just disclose it in the notes to our financial statement. A good example of this, when Volkswagen had their emissions scandal, they had notes in their financial statement that says, we've done some bad things, we've gotten in trouble for it, it's going to be really bad, it's going to cost us a lot of money, but we don't have any way of knowing how much it's going to be at this point. They had that note in their financial statements. And then the third category, what if the likelihood is very remote? Then you don't even need to do anything at all, which kind of makes sense. So again, one type of this is warranty payable. So let's take a look at that. So in this case, a company sells product costing $20,000 for $50,000 in cash. So line 1A, we recognize cash coming into the business, we recognize revenue. On line 1B, we recognize the reduction in inventory for the cost of those goods, and we recognize cost of goods sold. Retained earnings goes down. Then at the end of the year, we make an estimate of what we think our future warranty expense is going to be. So we may base that on our past experience. If we've been in business for a while, we might base it on industry averages if we can look to what other companies in our industry do. In this case, the company estimates that 1% of their sales is going to be the future inventory or future warranty expense. So in this case, the company had $50,000 in sales if it was just this one sale, and they would recognize a payable. So they accrue warranty payable and they recognize warranty expense. Again, that red line there shows the end of the year. So they've recorded the payable and the expense in the same year in which they made the sale. So there's good matching there. So then in this case, in the following year, they honor a warranty claim. Somebody comes in and they need their product fixed. It's going to cost $100, or they need a $100 part. So in that case, we reduce our inventory because we give the repair part to the customer. and we don't recognize an expense at that point because we already recognized the expense. So in this case, we reduce our payable. So now we have $400 left for future warranty claims. Hope that makes sense. So I'll stop at this point. I'm trying to keep these lectures to about 15 minutes. I'm sure that's all that's bearable. And I will again post an exercise here in a few minutes for exercise 9-1A that will help you with your homework. So I hope everyone's doing well, and I look forward to hearing from you. Bye-bye.